Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us. It's Friday. It's so nice to have you here, Jim. How are you?
I am good. How you doing?
I'm doing great. It's Friday, and it's been a crazy week. We're trying to navigate through all these headlines, and there's been a lot of data that's been moving the markets,
Yeah,
and I have to say the stock market is trading pretty heavy.
yeah, yeah. Well, when we talked last week, and we'll get to some couple charts obviously a little bit later, in terms of looking at what the broad market was doing and how it had already declined their equivalent low of 42.16, which suggested to me that we were going to see a decline below 42.16, which was the prior low from a week or two ago, and potentially down below 41.50, just using some measurement techniques. And, we saw that. And, it doesn't surprise me. The strong GDP, concerns people regarding what the Fed may or may not do. And maybe the most important aspect, Blake, is the big cap stocks came out with earnings. And on balance, I mean, Google wasn't great, but the other ones were all right. And yet people sold into whatever strength happened in the after hours. And so to me, that just kind of shows a shift in sentiment from buy every single dip in those stocks to, you know what, maybe it's time to take some chips off the table.
Yeah, it's horrible price action, and this is a discussion that we've had pretty much every morning on our face show
Yeah.
in our community. Is that when you get a gap in crap, stocks gap up and then they just fill those gaps. That's really poor price action, and
Yeah.
we're seeing that almost across the board. I mean, there are some exceptions, obviously. But that's something I guess, as traders, we definitely need to be aware of. Now, we have an important week next week. I mean, we're trying to navigate through all these, geopolitical risks. Hopefully there's some maybe a ceasefire over the weekend. Maybe we can kind of put that maybe not in the rearview mirror because
Right.
it's not peace
Yeah.
talks. It seems like ceasefire seems like let's return some hostages or something like that. But at least we can put it on the side burner because this next week we got a really important week, don't we?
We do. And the Fed meets on Wednesday. I think the consensus is that they won't raise rates in November. That's been a position I've had really for quite a while, for a lot of different reasons. And I think despite the GDP number that we've seen this week for the third quarter, 4.9%, that's a big number. I think the Fed will postpone doing anything until they get to December. It buys more time. In December, they'll do another dot plot and everything else. And so, yeah, they really want to see the economy slow. They still expect that to happen. I certainly believe that. But I think the main thing, Blake, is it'll be the same thing that we saw kind of last meeting. We're not raising rates. Every meeting is a live meeting. We're tilting toward raising rates at least one more time. And so it's going to be like we didn't do anything, but the overall jibe is going to be, the biases toward raising rates at least one more time.
Yeah, I was gonna say. So I'm gonna pull up the first chart that you brought us here in a second, but the GDP print, because it was so strong, it didn't change your outlook here,
No,
right?
no, it really didn't. For a lot of reasons. I mean, I think they just want to buy time and so forth. I think there were some aspects of that GDP number for the third quarter, like inventories, I think added 1.3%. So that's great in that corner. But as companies and retailers build up their shelves of merchandise, if consumer spending falters, guess what happens? They cut orders to pair that inventory. And that's been a big swing factor. In the second quarter of 2022, which was, we're in a recession. In that second quarter, it subtracted 1.9% because Target and Walmart and a lot of other, retailers had too much goods at a time when consumers had shifted from buying goods to spending money on services. So that inventory number can be a big swing factor. I just think the Fed wants to wait for more time. They don't want to be too aggressive and inadvertently tip the economy in a recession. All right.
Yeah, why does this have 2007, Jim? We are in, this is 16 years later, my friend.
Yeah, I know. It's kind of like a time warp, No, really, because it's coincidence that in the third quarter of 2007, GDP was up 4.9%. Third quarter of 2023, up 4.9%. My only point is there's a lot of people who, again, last year were in the recession camp. This year now they're in the no recession camp, and they would point to this number as proof positive, we're not going to have any stinking recession. And so all I'm trying to do is say things can change quickly. And we saw that in 2007. And that was after a period of time when, the Fed had raised rates. But more importantly, lending standards had tightened significantly throughout 2007.
And just to your point, Jim, I need to make sure that everybody understands you have been singing this tune for months that, hey, people were getting excited about a recession. We ain't going to be a recession yet. It might be a technical recession, but really isn't a recession. Then now that it's reversed, you're like, the way the market's going to get caught off guard is because everybody's going to say there is no recession coming, which they are right now, but you do still think otherwise.
I do. We've talked about this stuff kind of ad nauseum in terms of the delayed reaction from things like the inverted yield curve. The average lead time is 19 months. And we're now just getting into that window of time. Leading indicators, we're beyond that window of time. Lending standards, it's about 12 months. We're entering that window. And I think the main thing, Blake, is that consumers had a lot more money going into this period of higher interest rates than they ever have in any other prior cycle. That only, to me, suggested, you're going to stretch maybe these windows, the lag time windows a little bit. I don't think it negates the ultimate outcome. So from my perspective, I thought third quarter we would see some slowing. Obviously, that GDP report kind of said not really. The third quarter consumption was up 4%. That added 2.8% or so to the GDP number. I still believe, though, that we're going to see things slow in the next 6 to 9 months, fairly significantly. People have forgotten about the things like the commercial real estate problem. That's going to rear its ugly head as we get into the first half of next year. It's going to lead to.
I was going to say to next chart, you talk about financial conditions. This is part of it, right?
Yeah, this is maybe the biggest reason why the Fed isn't going to be increasing the funds rate next week, because since July, the dollar is up about 7%. We've seen Treasury bonds sell off significantly. The stock market's down, I think, 8% on the S&P, and spreads have widened a little bit. And those are all things that reflect tightening financial conditions. So when you get that kind of a reaction, in a sense, and you've heard other people say this, I'm sure, the markets are kind of doing some of the work of the Fed. The 10-year's up, 75, 80 basis points in the last couple months?
Right.
So is that equal to at least one rate hike? Absolutely. So that to me is the main reason why the Fed won't raise rates at the next meeting, because rates effectively have already been increased by the change in financial conditions in the market.
Well, you had mentioned one of them was the dollar. So the dollar has it seems like it's reasserted itself, where just last week, and I'll do a little bit of drawing here just for you, because kind of put everybody's perspective in. We were in last week. We're consolidating, and then early this week we dropped. I think it got a lot of people short the dollar. Next thing you know, the dollar's up in everybody's face. So what are we doing here?
Well, again, I was looking for a pullback. I thought once the dollar closed below 105.65, which it did a few days ago, I think it closed at 105.59. The next day, it dropped, I think, 105.36, and then boom, up. And then, of course, the GDP report gave it a little bit more of a boost. So clearly now when we step back, we can see, okay, A, B, C down to that low at 105.36, and then this rebound. there's two paths. Either that's ABC down for wave A of what I would call wave 4, or hey, that's all of wave 4, and the rebound from this week's low is wave 1 of 5 that has the potential to take the dollar up to the 109, 110 area. All right.
Wow.
So
that would be
what could cause
pretty. That would be pretty
significant.
Yeah.
So to me, I think I can't look at the markets right now, Blake, without incorporating the Middle East into the understanding, if you will, or thinking. So when I look at the dollar, hey, if that war begins in earnest, well, that would support a dollar rally up to 109, 110. And to me, all the tea leaves are moving in that direction. We want to wait and talk about hostages. Well, we've gotten 2 out. How long are we going to wait? Like in 1980 with President Carter, 400 and some days? Not going to happen. In the meantime, we're seeing strikes from Syria and Hezbollah on U.S. assets. Well, we just sent an F-16 to blow up some things in Syria yesterday. We've seen ground incursions by Israel in tactical, if you will, probing of parts of Gaza. So to me, all these things are leading up to the event. And I just think there's the potential that this thing could get much broader than we obviously would want to see. And I think that event has to be considered when we're looking at all these chart patterns. So to me, how could the dollar get up to 109, 110? Yeah, war breaks out. Yeah. Absent that, the other pattern is ABC down. This bounces a B wave, and we're going to see another correction down towards the 104.40-ish area to complete wave 4. But, consistently what I've been saying, after we get this correction, I still think the dollar is going above 107.34. So you got 5 up. It looks like an advancing wave. That implies that after a pullback, there's going to be another push up.
So what does that mean for yields? Because just like it seems like the bond market cannot get out of its own way, and it seems like yields are going higher. It's supply, but the market's really short the bond market. So, what do you think?
Well, here's the thing. When was it? I think it was Monday. I did a special report on TLT, and some of the things I covered was that late last week you had the 30-year go to a new low, but the 10-year didn't, and that's an intermarket divergence. Now the opposite happened in March, where the 10-year yield went to a lower low, and the 30-year didn't. And at the time I said, hey, that's a negative intermarket divergence. These are the types of things that in the bond market happen at turning points. So that was a plus. Last week, both the 10 and 30-year made new closing lows, but the RSIs were higher. And you can kind of see this is on yield. I'm talking about bond prices. But on this chart, you can see on the 19th, we made a new closing high, and you had a big divergence. And the other significant thing, which I've talked about, is that it's one thing to have a divergence, but if the RSI is still comfortably above 70, that's still showing inherent strength. This divergence was with the RSI right around 70. So it really shows a loss of upside momentum. On Monday, after the 30-year went to lower lows, you had a 2-day key reversal. So it took out the lows of the prior 2 days and then took out the highs of the prior 2 days, and you had a closing low. And then lastly, I don't have it up here, but if you look at a weekly chart, you had an RSI divergence relative to where things were last October and now. So technically, there's a lot of evidence to suggest we're nearing an inflection point of bond yields topping and then coming down and a rally in the bond market. So the other interesting things, markets sometimes reveal more information in how they respond to news. So we had this blowout GDP report. Bond yields dropped. Now, you mentioned shorts in the market. To me, if I'm short and you get a 4.9% GDP number and bonds don't sell off, that's the kind of thing where it's like, okay,
right.
This thing may be sold out. It's maybe time to cover. So as what we saw during the course of the day, yields worked their way lower. So to me, there's mounting evidence technically that we're going to see. If a broader war breaks out in the Middle East, I can't imagine Treasury yields not coming down.
Yeah.
Somewhat significantly. So technically, I'm looking at the 480 range on the 10-year, getting below that. That would kind of get you almost below that blue line where we broke out above. So again, I think the odds favor we're going to see yields come down, and they could come down pretty dramatically if war breaks out in the Middle East. And all of a sudden Hezbollah gets into it. I mean, again, one thing I'll mention, and I'm not knowledgeable, let alone an expert, but Israel's renowned for their intelligence gathering process. I mean, like everybody acknowledged, well, they're the best. So we had weeks of Hamas doing stuff, and they didn't supposedly see any of it, okay? And honestly, I almost think, was that intentional? Because ultimately, Iran wants to build a nuke, but Israel really needs a good reason. You just can't fly over there and bomb the hell out of Iran nuclear facilities. So is that what this was all about? A precept to potentially, the dominoes fall. There's no question that Iran has been training, monetarily financing Hamas as well as Hezbollah. So anyway.
Oh my gosh, I got my
looking at this chart.
Where is my
it's kind of like technically, hey, it's suggesting yields are going to come down. Now, is that because all of a sudden we're going to start getting softer economic data? Probably. I mean, anything is going to look a little pale relative to 4.9% on the GDP.
Yeah, right. Okay. All right. Well, what does this do for gold? Because gold has not backed away. I mean, gold has been so strong. What do you think happens here?
It's impressive in the sense that, for much of the last year and a half, anytime dollar strength occurred, gold, struggled, if not outright declined. Mm-hmm. So I'm looking at this, I'm thinking that, we had this huge pop in a short period of time. We're consolidating. I think there's one more pop, and my guess is it can get up to the 2031. I mean, it could get up to 2050, in other words, the prior highs. And again, will that happen on an outbreak of war? I think so. Just a boom spike. And then if the dollar continued to motor up to 109, 110, that would be the perfect excuse for wave two. So again, we talked about this from May, looking for a pullback under 1850 for a wave two low. And then we're going to see wave three take gold to new all-time highs. I think we've seen the beginning of wave one. My take is it's not quite complete. You get one more pop, then a pullback. And then as we get into next year, I think as economic weakness becomes more pronounced in the U.S., the dollar is going to have a pretty good correction. And that's really so I think gold is setting up to do quite well next year.
All right. Well, you brought this chart to us before. This is the S&P weighted, equal weighted index. It looks not bullish.
Well, in a way, perversely, it is.
Okay. All right. Tell us why.
So last week it was like, hey, look at the equal weight. I also showed the value line. Both of those averages were below their early October lows. And, they cover a lot more stocks than the S&P. And to me, this was pointing the direction that we were likely to see more weakness in the S&P before a low took place. The reason why it potentially is at least short-term positive is from the high at 155.77 in late July, you can see 1, 2, 3, 4, 5. And last week I said, okay, the target is around 154 or 134, maybe a touch below. And this morning it got to 134.25. So for me, Blake, this looks like, all right, you're completing 5 down, and that implies that there should be a rebound. And the target would be, as I have up there, 143.50, which is wave 4 of lesser degree. The 50% retracement's at 145. And then that blue trend line, you can see kind of connects highs going back 6 months ago, the low we saw in mid-August, Now, all bets are off if war breaks out. I mean, you can throw this stuff out the window.
Yeah.
Reality has a chance to supersede. I think there's the potential that, barring that, there's room for a rebound based on this chart pattern. 5 down, we should have some kind of retracement rally. And then, again, I think next year, if I'm right about the economy slowing materially, I can't see that is initially going to be positive for the equity market.
Jim, as we're talking, some headlines have come across saying Israel cuts off communication from the Gaza Strip and launches the most violent attack since the beginning of the war. And that's all Arabia news. So just a little heads up. And we're at session lows right now.
There's the potential. It's a 1-2-1-2, and we're going to have a mini crash here. So these price patterns are nice and neat and clean, but we're in a really, really dangerous world right now.
Until the unthinkable happens, right? Right.
Yeah. Unfortunately.
So the last chart you brought is the S&P. You whoops, I went a little bit too far. You think this could be wave 5, but again, this is all off the.
It could be a 1-2-1-2, and we're
not going to get crazy.
We're going to get slammed. Okay, now at the bottom panel shows a 21-day oscillator that I use of advances minus declines.
Yep.
And what I find is when you get into intense selling periods, typically what happens is you get a fairly oversold reading, which that minus 440 is. Anything below the green horizontal line means you're getting kind of oversold.
Right.
You get a bounce, and then you go down, and ideally you get a positive divergence where that oscillator hits a higher low. Well, we have that in place. Now, the divergence is not all that extreme, but it too implies that we, all else forgotten, just looking at the technical aspect, a rebound in the S&P back towards the 43.33 up to 44.20. We have the only way you can make some guesses on this stuff, and then as it starts to unfold, you measure the length of things, and you can kind of make a more accurate guess. But that's what this is suggesting is, okay, you could get a 50% retracement up towards 43.65, and then we'll take it from there.
Well, Jim, I want to make sure that everybody understands that this is obviously we're a headline driven market. Right now headlines are hitting the wires. Stocks are sitting at session lows as we go into the weekend, and we got a weekend where the markets will be closed and anything can happen. So just make sure that you guys are not have tunnel vision for technical analysis. Keep your eyes open for all the headlines that are coming across. It's definitely a very fluid situation in the Middle East.
Yeah, I mean, when they talked about getting the hostages and geez, be careful, hold off on that ground war. Well, what's happening behind the scenes? We're getting more and more military assets. We have now a second, aircraft carrier group in the Middle East. Other nations are sending some military equipment and so forth. So to me, this has the potential of being a big deal.
Jim, I know you have grandkids, and they're very, very fun ages. Have you ever seen the movie Up?
Oh, is that the balloon one?
Squirrel. So it's a dog that gets sidetracked by squirrel. That happens a lot during these types of situations, that diversion tactics over here, but what really is happening is over here. So
I mean, we look good when we say, let's calm down, don't overreact, let's get some hostages out. In the meantime, let's get as much military assets in place for the big one, potentially. And so to me, it's a scary time. And so when I look at the charts, I can make a case for a 1-2-1-2 and a puke.
I don't want to make light of the situation, but that's military tactics for you, and you have to be. That's why you have to be keenly aware of these types of things, and it's not always as it seems. And I think the best thing for traders really is to make sure you play defensively and keep your positioning
exposure Smaller.
Yeah, exposure reasonable, smaller, meaning so if things don't go your way, you can sustain some volatility. So,
yeah, no, that's sage advice.
Yeah. All right. Well, Jim, we appreciate your sage advice every single week.
Nice
What's
segue.
the best way for traders to follow your work?
Macrotides.com. I just had the websites revamped. We got some good information there.
Great.
So take a look.
I'm going to check it out. I know you were telling us last week to wait for that. And so it is out. Make sure you all check out Macro Tides. Send Jim an email. Say, I saw you on Traders Summit, and Jim will take care of you.
I will. Hey, have a great weekend.
You do the same, Jim. Thank you very much. And thanks, everybody. Make sure you give Jim a big thumbs up for being here every single week. And make sure you subscribe to the channel so you don't miss any of this exclusive content. Thank you, Jim. We will catch you next week.
You got it.
Hey, traders. Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also, click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.